Hi, it's Aoife Devitt, and welcome to today's Markets Happy Hour podcast. It is late in the day on Thursday, October 2nd. I now have learned that it is not possible to record a podcast from an aircraft, whether it's taken off or not. Simply no Wi-Fi at the outset and too much noise during flights. So had to wait till I landed here in San Francisco to record this podcast, although the materials were prepared earlier in the day. So this is the eve before we have a live podcast event in San Francisco, which will be released late into the day on Friday. And we'll have a bit more of a tech angle to that one. But this will be usual proceedings here today. And let's kick off with the slides. So I've called today's podcast Memes and Milestones, as we are now into day 3 of the US government shutdown, yet the zone seems to be flooded with memes of Mexican sombreros and mariachi bands. So it's hard to know whether this is a comedy act or whether something very serious is going on. And some of the milestones relate to yet more relation to the law of large numbers that we started to talk about last week. And we will launch into some of the same topics that we discussed last week, but perhaps filling in some more detail, as that was quite a busy podcast last week. So we're going to speak as usual about inflation, interest rates, geopolitics, interest rates, equity markets, and other asset classes, and of course what it means for your portfolio. And we are now, as I mentioned, day 3 in the middle of shutdown shenanigans in the US. Let's see how long this lasts, and markets will certainly be watching closely as to see how long it lasts, as for now there seems to be absolutely no effect on bond markets or equity markets. But the longer this grinds on, the more likely there is to be job cuts, to be pain, to be delayed infrastructure projects, and that is likely to take its toll. We have passed the end of the third quarter. We can now look back at that quarter with a bit of a redux and speak about what was a surprisingly strong month of September. I mentioned before the law of large numbers, and there have been some more record-breaking deals announced this week. And we can also talk a little bit about some of the news flow that has been circulating after last week's big news. And then, of course, in geopolitics, we still have a rumbling of stress and conflict around the world. And we're hearing about peace plans, we're hearing about peace dividends. So far, nothing concrete, though, that can either move the sentiment around geopolitics or move markets in that respect. So looking at shutdown shenanigans, as I mentioned, it started at midnight on Wednesday. So just the all day Wednesday, Thursday, going into day 3 now on Friday of the shutdown. Just doesn't seem to be much room for an either bipartisan agreement or for alignment between the two sides. And we are still looking at an impasse, essentially, and hearing about the shutdown of infrastructure projects and vast cuts being made to government offices. If we look, though, what's happening with equities seem to be somewhat oblivious to this. They are racing to an all-time high. We've seen that in the S&P. We know that the S&P has now had 29 all-time highs so far this year, while the Dow has had 9 records broken. The Nasdaq is slightly off its highs, but is still doing extremely well. And if we also look at what the bond market is doing, we seem to have just rolled on from the expected rate cut of the Fed in the last few weeks to now have the bond market focusing on what they can expect for the next one and when that is likely to come. So we can already see that the rate cuts and where we think the implicit December 2025 Fed fund rate is likely to be is back to a 5-month low, so just around the 3.5% mark. So contemplating 2 more 25 basis point cuts before the end of the year. And it's interesting to look at what equity markets actually do when there has been a shutdown. If we look back to earlier shutdowns, and the most recent one in recent memory was in 2018, and that was again under Donald Trump, the Republican administration. This chart shows the S&P moves during earlier shutdowns, with red for a Republican administration and blue for a Democrat administration. And we can see that in recent years, since going back to 95, the S&P has always performed positively in the event of a shutdown. This doesn't necessarily calibrate for the length of the shutdown, as clearly the longer the shutdown goes on, the more dire the outcome could be, and perhaps the more permanent some of those furloughs could be, or some of the setback to expenditure and to discretionary income. But a shorter shutdown, such as we're experiencing now, generally could just be a temporary effect on the economic activity. But if it does get protracted, it could have a sluggish effect. But as we can see, equity markets behaving exactly as we would expect them to in the event of a slowdown, a shutdown like that. And we're still talking about tariffs, even though there is somewhat a confusion as to whether or not detail has been ironed out and whether certainty can be given to the trading counterparts in that. We know that the OECD is projecting that tariffs will slow the US economy. They're saying that will hit it hard in 2026. On the other hand, we see this spike on the chart on the right in terms of the duties that have been collected from US imports monthly, now close to 30 billion of the month of August collected from imports. So clearly quite a strong offset to any pain that would be experienced at the consumer level, at the corporate level. But those funds are not being redistributed at the moment. We know that those funds have been accompanied by tax cuts, so that any supplement to the revenue that provides is going to be offset by cuts in other areas. And we know that spending has not been cut to the degree desired either. So there's not a lot of wiggle room for giving back those tariff revenues. But we do know, however, that tariffs continue to be essentially a stalking horse when it comes to the outlook for the economy. And even in the past week, we've heard about 100% tariffs on film. We are still wondering about tariffs on pharmaceuticals, the launch of Trump RX, as a direct-to-consumer access to pharmaceuticals, which gave a great boost to pharmaceutical stocks just in the past week. And then we also have the tariffs that were announced in recent weeks, such as around cabinets, etc. So a tremendous amount of uncertainty still, and definitely the threat being waved out there as to tariffs. And that is, of course, creating tremendous uncertainty for our trading partners too. But for now, a bit of a mixed effect on the economy. When we go back to some of the issues we were discussing in terms of a vibe check last week, we can see that this week we are still discussing Fed independence. We know now that the Supreme Court has now been has ruled on the fact that Lisa Cook can retain her job for now. That was considered to be the last line of defense for Fed independence, and that has been pushed back now to January when that case can be heard. Overall, that is some sort of form of victory for Lisa Cook, in that other courts have demurred in terms of getting in the way of the exercise of this discretion. But we know there's at least a few months stay of execution there. However, as we've discussed before, as the chairman, Chairman Powell's, as we get to the end of his tenure and as April 2026 approaches, really the risk of a firing or the risk of anything happening to him in the last few months has less of an effect on the impact of Fed independence, as we know that a new chairman is coming anyway, that could very likely do the president's bidding, but equally could be very likely not. We have also had quite negative numbers when it comes to jobs, and this has been behind the increased conviction that the Fed will continue to lower rates. So in this case, they came from ADP, so they're private numbers, and we can see that the US has lost 32,000 jobs in September, and this would be a change in private sector jobs from a month earlier. So heading in the wrong direction. If we look at this chart, we can see that there was a surprising gain at the beginning of the new administration, beginning of January, February, March, so 3 consecutive months of gains, actually right through to May. But then there has been much more choppiness in those jobs figures ever since. And on the back of the already weak jobs numbers that were the payroll numbers that were issued last week, we know that there will likely be an interest rate cut coming. On the other hand, when it comes to equity markets, we've seen that records are continuing across the board. This particular week, we've seen strong performance from the NASDAQ, the S&P and Dow Industrials. And as I mentioned, the 29th record of the year for the S&P, the 9th record close for the Dow, and the NASDAQ composite rising 0.4%, but still finishing short of its all-time high. So very robust signs coming out of equity markets. And equally, this is actually demonstrating more breadth in equity markets now. We know that the Russell 2000 has also been participating in this strength, and that has been a good sign in terms of investors seeking to have exposure to equities beyond the mere top 10. If we look at valuations, however, this is sending some alarm bells through market watchers. We've also had the Fed weighing in that Chairman Powell has had some opportunity to make remarks. I think he has given indication that he is warning about the stock market valuation. When we see that number of highs in a year like 25, we know that certainly we are reminded of the irrational exuberance comment made by Alan Greenspan many decades ago. Whenever there is a warning on stock market valuations, it can often come in advance Not always, as this chart would show. Sometimes those warnings can come quite early, such as between 2010 and 2020. But when a warning did come around the time of COVID, that did precipitate a large drop in the market. So in terms of the valuations. So if we look at the S&P price to earnings ratio today, we are not at an all-time high, but we are creeping up there. We are creeping up to the 30x level. Of course, we should be reminded, though, that some of those earnings are a lot more robust today than they would have been in the past. So it's not necessarily a like-for-like comparison, but we are reaching somewhat stretched valuations in equity markets today, and that's something that we have to pay attention to. Besides the valuations, these are charts from last week where we talked about the technical factors that were behind the supportive backdrop for equities. These include the assets and money market funds, well in excess of 7 trillion now and heading higher again. That is the dry powder that is on hand that will probably not be satisfied by being held in cash or being held in bonds any longer. And we can also see that the money market yields themselves, just as we showed the chart showing the yields coming down in the expectation of Fed rate cuts, money market yields have now pushed below 5%, heading towards 4%, no longer as compelling. And we haven't talked about inflation this week, but we know that inflation hasn't moved, but we also know that it's quite sticky, certainly well ahead of the 2% mark. So when money market funds come down, when inflation at an average level is still well ahead of 2%, that just will not cut it in terms of allowing savings to compound. So that's why we believe this is a very strong, supportive underpinning for equity markets. Other technicals that remain strong will be the flow into equities. And we've already seen quite a bit of flow into equities, especially at dip points. But we can see that the net inflow to US listed ETFs continues to be very robust. In 2025, it is already tracking to be annualized at a higher level than 2024. And US listed ETFs, seen as a tax efficient alternative to mutual funds, clearly quite a strong draw. And again, more just another technical factor that would suggest that the equity market strength still, even if it's past its valuation justification, could have some ways to run. Another interesting development this week, we've had a little bit of fads. We've certainly heard about meme stocks before, and we know that Bitcoin has had its moments in the spotlight of being a fad or not. Some news flow this week around the Bitcoin treasury. That seemed to be a phase that some companies were completely converting to either to a Bitcoin treasury business model, or were touting their use of Bitcoin in their treasury. We can see that there was a flurry of activity around the middle of the year around buying Bitcoin to leave in the treasury and to get the benefit of that, essentially in stock market valuations. That has died down now, whether because it was a fad or because it simply has been seen to be not so robust when companies have just done this. So I'd say that's another indication just of the ebbs and flows in Bitcoin, and we do need to watch for that because we know now that also that the depth of the Bitcoin market probably is still not yet what it was in its prior iteration. It's the depth and the breadth. So we don't have as many speculative interest in Bitcoin because we just don't have that interest from the smaller investor, having been burned a little before. And that smaller investor is probably now getting satisfied by being invested in large cap equities instead. So with less depth in Bitcoin, there is likely to be more volatility. And that's something certainly that we've seen in recent months, more volatility in Bitcoin. Moving now to some of the large transactions that were announced this week. And as I mentioned, there has been a flurry of activity, whether it's on the political front, the shutdown shenanigans, or now continuing us to see large numbers in terms of deals that are being announced. Last week, we mentioned OpenAI and the investment by NVIDIA of up to 100 billion in OpenAI over the next few years. That was basically tied to its commitment to support data center and power capacity. And we know that OpenAI has expanded its Stargate AI project with 5 US sites. So the cost of this initiative at 400 billion. So large numbers being spent. Continuing its propensity to bust through norms, OpenAI has just now closed a 6.6 billion share sale, mostly secondary sale for its employees, to allow employees of over 2 years to sell their shares. It's now sold at over at 500. It's a 500 billion valuation itself. That's up significantly even from the beginning of the year. So clearly a company that is now broaching higher and higher limits when it comes to its ambition as well as its valuation. Other big numbers that popped out this year, this month, we've heard about Electronic Arts as one of the largest LBO leverage buyouts in U.S. history, 50 billion, a trifecta of Silver Lake, a Saudi wealth fund, as well as Jared Kushner's fund there. And that is it. Not only is it an indication of just the sheer might of some private equity funds, but we can also see again this enduring appeal of getting out of the public eye, the pressure of quarterly earnings, and having the ability to chart one's own destiny as a private company continues to be very compelling. And we are likely to see more and more of that. We've spoken about dry powder in the past with respect to getting into equity markets. Clearly, there's a tremendous amount of dry powder, not only in some of these dedicated funds that have been raised, but also in the Middle East among these sovereign wealth funds. And there is a willingness to be nimble, flexible, and move quickly. And if we look at just the experience of Electronic Arts, the yellow line here in the graph, it has had a fairly lackluster year to date, although it's tracked the S&P. It has not been up to the stratospheric levels that we would have seen with Roblox or Take-Two. So has failed to break out with its true potential, had some setbacks when it comes to launches, and now just sees that things will be much quieter and much happier on the private side of the fence. We've also seen, similar with Warren Buffett, the first deal out of the gates for the CEO-elect there, a $10 billion deal. That is just a sign that Warren Buffett is still seeing opportunity, still seeing companies with those moats. One area we didn't talk as much about last week, although it's still rumbling in the background, and if anything has been exposed past the headline for being a fairly, I wouldn't say ill thought through, but a fairly barely thought through initiative, which is the lifeline that has been extended to Argentina. And we've had many guests from Argentina on this podcast. I'd say they were in more optimistic times, perhaps, and when it seemed like the Javier Milei strategy was working well and was gaining populist appeal. The September 7th, 8th elections were set back to that, and that they certainly suggested that there was not the same popular appeal and that the coming elections could be more challenging for his mandate. And we've seen Argentine assets lose value precipitously since then, and that turning to Donald Trump and Scott Bessent and an overture or a lifeline from them has initially given stability there, but because there has been a lack of detail, that has now led to an erosion of confidence and more drag there. And when it comes to Latin America, though, I would say that the Trump effect is quite felt in a mixed way, in that Brazil and Mexico have so far been doing quite well. When contrary to expectations, perhaps they have had the ability to defer some of the impact of tariffs. We know that Mexico has a 3-month stay of execution on its tariffs, and they have not had the same fate as Argentina. Finally, on bubbles, we will be speaking about this more at the live event in San Francisco on Friday, but we are above of the discussion around the whether AI is a bubble. And it was some of those big numbers that triggered this this discussion in the media this week. And I think it's just interesting to have a reminder here of some of the things that underpin bubbles, the element of debt, the element of cheap money, and the element of an expensive valuation, as well as the narrative to explain away the high price. We certainly have the narrative. We don't have as much debt, but we have large amounts of equity capital being raised. Cheap or not, that depends from your perspective, but there certainly has been a strong supply, and perhaps cheaper than it might have been if there was less abundant supply, and certainly asset prices reaching the stratospheric levels there. So all eyes will be on this AI sector as to whether it starts to show signs of cracking, because that does seem to be certainly the saving grace of this economy, as much else changes in the background in terms of its potential instability. Other noise that we've seen just in the week, and less to do with markets, but certainly distracting from markets. We've seen the US Army and military leaders being brought to Quantico for a discussion around warrior ethos, which was certainly unprecedented. And we've also seen more universities get in the crosshairs, whether it is the defunding of Harvard or the request that certain colleges sign an agreement to get a funding advantage. Lots of unprecedented and really challenging pieces of news flow to navigate at the moment. And this is why it's important to decipher what is actually likely to impact markets and what is not. So that is it for today. As I said, a little bit later than usual, but we will be coming to you live tomorrow from San Francisco. We'll have a crowd that is a cross section of tech experts as well as some fund managers here in the city. And we'll get some perspective on that AI bubble and what the next 5 years might hold. Thank you very much, everyone. See you tomorrow.